Hello friends, my name is Vaibhav and I am the founder of a financial services firm in Bangalore which goes by the name Dexterous 2 Advisors Private Limited. In today's video, we are going to discuss about one of the taxations which has been reintroduced in the current budget, which is the long-term capital gains tax. It is largely being discussed through its acronym, which is LTCG. Now, in today's video, we are going to only restrict our discussion towards the two mistaken interpretations which people are making of this taxation in relevance to their portfolio. You see, the first mistake which people are making has two parts to it. One is the gain part, one is the loss part. The gain part is that people are going ahead and selling their equity, direct equity holding or mutual fund holding in one sweeping motion, thinking that whatever gains that they have made, long-term gains that they have made on their equity holdings so far is going to end up being taxed. One thing which you have to realize is that there was a concept of grandfathering approach also which was discussed while introduction of this tax. Whatever gains, let's understand it through an example that, say for example, you ended up buying a mutual fund or a stock on the 1st of Jan 2015 at the rate of 100 rupees per unit and ended up selling it on the 31st of December in future, December 2018 at 250 rupees per unit. On the 31st of Jan, suppose the value was already 200 rupees. The 100 rupee gain which you have made is not going to be taxed. It is going to be completely tax free. That 50 rupees alone which you make thereafter, the introduction of this budget rule, only after which whatever taxes that you have made, that alone is going to be taxed at the rate of 10%. So if you're going ahead and selling your whole portfolio just to avoid the taxation, you have to revisit that decision of yours. If you are being recommended, you have to re-question that decision before you go ahead and execute the transaction. The other mistake which a lot of people are also making, thinking that since the market is been down, we are recording this video on the 2nd of March 2018 and the equity market overall is net negative from the 1st of Feb 2018. So there are a lot of portfolios which have suffered depreciation in the value since the 1st of Feb 2018 till now. So a lot of people are selling it thinking that they will book losses, and these losses they will be able to book in future against whatever gains that they are going to make. Another thing you have to realize is that, say in the same example, if you had bought it on the 1st of Jan 2015 at 100 and on the 31st of Jan you were at 200, suppose now you are at 180, that is not going to be taken as loss. You have not been given that advantage. It will be considered as a nil situation. No loss, no gain kind of situation if you end up selling it. Not that you will be able to book a 20 rupee loss and carry it forward and book it for any gains that you end up making in future. That is not going to happen. The loss is only going to happen if, say, your current value is 80 rupees. So you bought it at 100 and you're selling it at 80 rupees. There is a 20 rupee loss. Only that, then there is a loss to your portfolio. If at all you are ending up just selling all your equity portfolio in a sweeping motion to avoid taxation, you have to revisit that decision of yours. If at all that is being done for tactical and strategic asset allocations, then fine. Then you can do it for rebalancing or de-risking of portfolio or to cater to any future liquidity requirements, which is what is both these allocations, then fine, then you can do it. Then you don't have to worry about whatever we are discussing in this portfolio. But if at all it is being done to just avoid taxation, revisit that decision of yours. The other mistake which a lot of people are ending up making is that they feel that equity will lose a lot of relevance going ahead because of the taxation. You see, any investment, of course, taxation plays an important aspect to the decision making. But any investment, when it is made, there are two most important aspects to it. One is the gains that you are going to make. The other is the risk that you're taking by investing in that asset. Those don't get affected those two decisions don't get affected because of the introduction of this tax. Tax alone doesn't play a decisive thing. Of course, it is going to be one of the, it has taken away a little bit of advantage from equity, but doesn't mean that equity will stop shining hereafter. It still remains as one of the most attractive assets. Taxation alone, if it was going to be the reason for deciding an instrument or an investment, all of us would have been farmers, because farming income is not taxed in India. But the very fact that so many of us are pursuing alternative careers is because we found it more lucrative. So be very candid in just jumping to another instrument for the purpose of avoiding this taxation. That is all that I wanted to bring to the notice of all you fine investors. Hope you like the video. If you like it, please press the like button, subscribe the channel, and share it as much as possible among your friends. That will be really encouraging for all of us. Thank you for watching.